shall we start with a silent prayer? Okay, thank you. This day is one of the most prestigious day in our faculty development program. So here I'm introducing our most prestigious resource person, Mr. Vipin Ji, the head of products and service Geojit Financial Limited. He has been in the Geojit for the past 18 years and has been an instrumental designing and developing in the online platform, including mobile mobile platforms of Geojit and the company. When the company has been in the pioneering stage of Indian market to introduce the online and mobile trading, he is been one of the most pioneering. He is one of the most of the person who is working with the Geojit. So he has been also closely associated with the designing and the various capital market products of Geojit and smartfolios and other online mutual funds and other exposure products. So we can surely say that Mr. Vipinji, one of the highly priced stock in the current scenarios. So I am welcome Mr. Vipin to our FDP program for the Department of Commerce and for the Sri Sankara College also. Welcome you, sir, and the space is yours. Thank you.
Thank you, Srini. Shall we start the session?
Sure, sir, sure.
So thank you, Srini, for the welcome speech, and good morning to all participants. Okay, couple of sessions I had attended in the last inaugural session or something I had attended. So I will just go through the slides which I have prepared. Thereafter, we will go to the main trading platforms. So to just introduce the trading platform, I would like you to get attention to some of the settlement cycles in the exchanges and some of the terms that are being used in the capital market circle. Okay, so I think it might I might be repeating some of the slides because there was a series of programs for the financial market, and so it might be a quite repetitive. But the thing is that since we have to fall into the trading platform, we have to just touch upon some of the points. So bear with me if I'm repeating any of the slides. Okay, so stock market is just like any other market, wherein you can bring in your stocks instead of your commodities. You are bringing your stocks in the form of digitalized stocks into the market, and you are identifying a seller. Okay, you might be a buyer, so you are trying to identify a seller who would like to sell his stocks or sell his shares or sell his part of the shares to the market, and you are a buyer who is approaching the market and would like to acquire some of the shares in big companies or in mid-cap companies which are listed in India. So basically we have two main stock exchanges, the Bombay Stock Exchange and the National Stock Exchange. So Bombay Stock Exchange, of course, this is the oldest stock exchange in India. And in terms of capitalization, BSE is almost to the top 10, 12 exchanges. And when it comes to NSE, because NSE started off very late in around 1992, wherein we had a concept of online trading platforms came into force. So thereafter, NSE took over the bulk of volumes. So if you see the share trading capital, I meant to say the share trading volumes in India, around 70% of the volumes are happening in the NSE. Whereas BSE is also supporting it. All the shares listed in NSE are almost 98-99% of the shares are listed in BSE also. So it doesn't gives you much difference on whether I am purchasing my stocks or selling my stocks in BSE or NSE. It is up to the investor to decide which exchange which exchange to go on, and he can commit the order. So established in 1992 and have started trading from the year 1994. So globally, if you take the NSE, it is the top 3 stock exchanges in terms of the volumes, because we have a good derivative markets, the F&O market, and also the intraday markets are also there. So due to that, the volumes are high, and we are almost to the top 5 in when we talk about NSE. This all NSE and BSE or any other participants in the market, the regulator is Security Exchange Board of India, SEBI. When it comes to the banks, we all know that it is the RBI, Reserve Bank of India. So similarly, SEBI have set off the provisions and the regulations for the capital market. So who are all the participants which come under the regulatory framework of SEBI? So all the exchanges, if you talk about NSE, BSE, we have the commodity exchanges. So all this comes under the exchanges purview, and so you need to so SEBI has given strict guidelines on the working of the exchanges. Then we have the depositories and the depository participants. We know that there are 2 depositories in India, and the depository participants like Geojit Financial Services is one of the depository participants. Then we have the mutual fund houses. Around 40 to 45 mutual fund houses are there in India at present. So these mutual funds also work under the regulatory purview of SEBI. Then we have the financial intermediaries, brokers, sub-brokers, etc. So Geojit also falls in that kind of financial intermediaries. Then we have the custodians. So custodians basically they serve the recordical details of an investor of a company or for the mutual fund houses. Then we have one of the biggest players called foreign institutional investors. So we have a good presence of FIAs in our markets. The security market are divided into 2. One is the primary market. Of course, you all know that what is primary market and secondary market. Just repeating on the primary market, this is the only place wherein a company is interacting with the investor. Okay, so the company decides that they will raise a certain, they will issue the shares and raise a certain amount of money from the market. For that, they give the fresh shares to the market, and investors take those shares by giving the money to the company. So the money raised by the company can be used for different things. Might be for setting of the debt, they would like to use that money for developing the market for expansion plans, etc., etc. So the document which getting published in the primary market, they often give these details in the form, and if the investor is interested, they can keep on investing. So we may not explain much things about primary market, because the trading platform or the live trading is all about secondary market. So that is the second phase of secondary market. So secondary market is why the primary market exists is because of the secondary market. Because if the secondary market was not there, then of course the primary market may not have any takers. Why you are going to the company to purchase shares? Why? Because you are sure that at any point of time, if the company grows, then if the company is expanded, then you have always a say on the shares that you hold, and you get a better pricing in the secondary market. So all the shares coming into the primary market are getting listed in the secondary market. And majority of the trading activities, see, when we talk about NSE, BSE, the volumes which we talk about all happens in the secondary market. And secondary market consists of equity markets and debt market also. We will just touch upon some of the main points on the indices. in the daily newspapers or in the daily news channels, what we have heard is that it comes with Sensex going up, Nifty goes down, etc., etc. So these are the news. So what you get, I think, majority of the retail investors or the retail or the ordinary people in the society, they come to know about these things only because they expect that, okay, index is up today or index is down today. So they don't know much of the difference, but between the different kind of indices which is available in the market. So basically there are around 4,000 plus companies listed in BSE and almost 1,600 plus companies listed in NSE. So the Nifty is, why it is called Nifty is because it is called the Nifty 50. The 50 stocks of the exchange represents the Nifty 50, and this 50 stocks actually is a basic representation of the whole economy. Okay, let me quote some of the example. See, the Indian economy is all about what? It is all about IT companies, steel sector, cement sector, banking, non-banking financial companies. We have the auto sector. Auto sector is again divided into the two-wheeler sector, the small car segment, the truck sector. Okay, then comes the pharma, then comes the oil companies, etc., etc. Agriculture. So these are the there are lot of companies in India. So if you take the good companies from all these sectors, you get a pool of your economy. So that's the reason why when we call, because see why economy is doing well is because you have a you have your good companies of steel doing better, cement is doing better, you have the infrastructure going on with the big development. So these all is an indicator of that the money is coming inside your economy. So that's why often it is treated as that when the markets are moving up or when the markets are going up, we always tend to say that we have a bit better economy waiting for. So the Nifty 50 is basically around 22 sectors, like what I told: oil and gas, steel sector, pharma sector, automobile sector. So likewise, the almost 22 to 23 sectors is taken and then is form a index called Nifty 50. So Nifty 50 when moves up or moves down, we can say that, okay, almost the majority of the companies in the Nifty 50 has gone up. That's all we can say. We cannot expect that every company in the Nifty 50 has gone up. Okay. Similarly, Sensex represents the index of the Bombay Stock Exchange. And so these are also represented by the same concept of Nifty. The only difference is that in Nifty it is the 50 stocks, whereas in Sensex it is the 30 stocks which is taken into consideration. So these are general indicators. You cannot see the Nifty or Sensex is not the only index which are provided by the exchange, but these are the only. This means that these are the only major indices in the market. Okay, so when I talk about steel sector or when I talk about the cement sector or when I talk about the pharma sector, it doesn't mean that the whole companies which are there in the index remains as such. It's not like that. It can keep on varying. So these all depends on the performance or the liquidity of the company in the market. So if any of the companies can move out, it can move out and then a new company can come in to the index. So these all depends on the market movements and also the performance of the company. So it doesn't mean that Infosys being one of the index component, it doesn't mean that Infosys is going to remain as such. It's not like that. It can keep on varying. If the company is not performing well, or if a better company comes into the prospect, then that would be the company in that particular sector. Whereas the other company which was earlier there will be moving out. So that it's not a fixed company list. Okay, so this was one of the example which I was quoting related to the Nifty. So these are the top companies which form in the Nifty. So you can see the majority of the weightage in the index comes to Reliance Industries Limited. So what does it mean? If Reliance moves a little up, since the weightage of the index is more, it will have more capacity of the index to move up. Similarly, the second comes the HDFC Bank Limited, then the Infosys, ICICI, HDFC, Tata Consultancy. So I just quoted only the top 10 stocks which have the top 10 weightage in the Nifty 50. Okay, so it doesn't mean that that's the only the index, the Nifty and the Sensex are the only index which are there in the market. I've just quoted some of the images of some of the major indices in the NSE. Okay, so Nifty 50, as you see, that's a major index which we have explained in the other slide. Whereas when you go into the other indices, okay, so it's called broad market indices. So Nifty 100 is there. Nifty next 50 is there. Next 50 is what basically it is the next emerging companies. Okay, so we have Nifty 200, Nifty 500. We have a mid cap of shares. Okay, an index forming only for mid cap. So likewise, it is called as broad market indices. Then we have another set of indices called thematic indices. So it works on a certain theme. So if you see Nifty commodities is what? It's the theme of commodity, because you have the commodity market and based on that a commodity is formed. Similarly, Nifty infrastructure, that's a theme based on only the infrastructure companies. If you come down, you could see Nifty 50 Sharia. So that's the Sharia complied companies which forms the Nifty 50. So these are some of the thematic indices. Then we have the strategy indices, which works on certain strategies. So it can be any kind of fundamentals. See, there is something called Nifty Dividend Opportunities 50. So that's what. So when you have that particular stocks getting invested, you get more dividends. Similarly, you have the low volatility 30 shares. Okay, so that means very less volatile shares are quoted in the Nifty 100. So these work on based on strategies. Then we have the sectoral indices. So if you think Nifty 50, thereafter the main concentration goes on the Nifty Bank. That's one of the sectoral indices. So Nifty Bank is what? It consists of the stocks which forms only the companies in the bank. The stocks forming the bank stocks will only form the Nifty Bank. Similarly, Nifty FMCG, Nifty IT, Nifty Media. So the term itself is very much evident that what each of the index represent on that indices. Just couple of words on the depository. We have two depositories in India, the NSDL and the CDSL. So if you wish to open a investment account, okay, you need to have two kind of accounts. One is the demat account, which is the depository. Second is the trading account, because trading account is the place where you enter your transactions, and whenever you trade in the trading account, the shares is getting credited to your demat account or debited from your demat account. So demat is basically a place where you store your securities. So a depository can be compared to a bank, because a bank is a place where you keep your hard-earned money. Similarly, the depository is a place where you safeguard your shares which has been bought from the market or which you have been applied through the IPO. So it is just a place where just to make a place to safeguard your securities. You can transfer between the accounts like a bank account. See, from a bank account, you can initiate a fund transfer, you can initiate a Google Pay, you can initiate an NEFT, RTGS, etc. Similar to that, you can transfer your shares to another beneficiary account. If you have a demat account, you can debit your demat account and credit the other person demat account. So transfers between the accounts is also possible. Transfers without actually handling the money. So you are actually transferring the shares without handling the money, because in the market when you purchase, it is the money transactions happens through the bank account. So you are actually not handling the money. Bank deals with money transaction. So see, there is a cash component coming in the depository. Just think of it. What would be the cash component? The cash component is nothing. It is the dividends getting declared by the company, because in the depository, when the shares are there, say 100 Reliance stocks are there with me. Suppose Reliance declares a dividend. Now that's a cash component. Okay. So this cash, which is declared as a dividend, will come to your bank account which is linked to your demat account. So that means what? Every time when you open a demat account, there should be a bank account linked to the demat account. Why? To have any kind of financial benefits, which financial, I meant to say the cash benefits which you get from your companies. This is the place wherein it will get credited. So it's not only equity shares. See, don't think that it is only the Reliance, the shares when I talk about it is not Reliance stocks or Infosys stocks or Wipro stocks which you can hold. Whereas you can hold your debentures, you can hold your bond, you can even hold insurance certificate, you can hold your mutual fund units. So everything of financial instrument can be held in a demat depository account. Couple of points on the mutual funds, because mutual fund will also be part of our investment journey. So this is basically a professionally managed investment fund, because you tend to go and invest a 5,000 rupees in Reliance Industries Limited. Okay, so it may not be a wise thing wherein you are just exposed to one particular company, because we don't know what happens to Reliance, at least for the short term. So you always have a risk of bringing funds only to Reliance Industries and investing. So we tend to go for the diversified investment. Diversified means what? At least your investment should be spread over to different sectors, and not only to different sectors. Inside the different sectors, it should be spread across different companies. So when you take, at least the investments say that at least you should have a spread of 10 to 12 stocks within 8 to 10 sectors. That's what the advice we normally give. But when you come in for the diversification with a small amount of money, then it won't be possible for you to get it diversified, because Reliance itself will cost you 2,000, Infosys will cost another 1,500, a banking HDFC will cost you 2,000. So that means with bringing a 10,000 rupees, you may not get that spread of your diversification. So what? You can invest through a mutual fund. So why? Mutual funds are better diversified, and it is properly diversified, and it is often professionally managed also. So you have a more choice. So there are many choices when you go for investment. You can go for only a sector wise investment, like a thematic investment which I was talking about. So based on a theme, mutual funds open the subscription, you can apply for that, etc. It is affordable. Okay, the best term to name mutual fund is it's affordable, because with 500 rupees you can start a mutual fund. That's the affordability which we are talking about. You get tax benefits, ATC. You get ATC if you are investing in a equity savings linked mutual funds, ELSS. Liquidity. Okay, liquidity means what? Suppose I want the money today, I can instruct my mutual funds to sell it today, and on T+2 I get the money. So that's what we call liquidity. It is transparent, because mutual funds often give the scheme documents to the investors, mentioning that okay, this is the place where we have invested last month. Okay, this is the percentage of investment across different companies, different sectors, etc. So this transparency is there. It is strictly regulated. Okay, because we have the regulatory of SEBI. Not only for SEBI, we have another regulation which have AMFI also, which is behind the mutual funds. The better term which you have been hearing for the last 5 years, especially those who are watching IPL or the World Cup matches, etc. SIP, systematic investment plan. So this helps you in the rupee cost averaging, because every month or in every week or in every quarter, you can instruct the mutual fund to have a regular investment. So always we say that it should be regularly investing. So you can regularly invest using the systematic investment plan. So that's all about the mutual funds. Now we will come into the we will come to the main section. We are almost to enter the market now. Before that, let us see what are the products that is available in the exchanges. We have the equities, we have the stocks, we have the ideas, we have the Then we have the ETF. We have closed-ended mutual fund schemes which are listed in the exchanges. Then we have the SMS listed on the Emerge platform. So equities and stocks are almost the same. Indian depository receipts, we don't have much of an example because Standard Chartered Bank was one of the ideas which was listed in exchange, which has been taken out. So ideas is nothing. I think you might have heard ADRs also, American Depository Receipt. That is the foreign companies coming into India and collecting the funds from the Indian community or from the Indian retail investors, and they list this company in the market. So ideas, we don't have much example. The only thing which we had was the Standard Chartered Bank, which has been delisted from the exchange. Then we have the exchange traded funds. So exchange traded fund basically is like a mutual funds. The assets might be the gold, Nifty, etc. So see, I can buy a Reliance, I can buy an Infosys, I can buy Wipro, I can buy TCS, etc. But when it comes to Nifty, if I have to buy a Nifty, I will have to go to the derivative market. But derivative market is not a better place where retail investors can enter for the first time. So ETFs, whereas for ETF, you can just start investing in Nifty also, because many of the mutual funds give Nifty ETFs also. Similarly, there is gold. Okay, that means every 1 gram of gold, 1 by 100 gram of the gold, that is say around 4,100 is 1 gram of gold. So if you invest around 1 by 100, 41 with 41 rupees, you can start investing in gold ETF. Similarly, units of closed-ended mutual fund schemes in mutual segment and SMEs. See, SMEs is basically small and medium enterprises which would like to list in Indian market, but since they don't have the capital of say it might be less than 25 crores which they have to go for listing. So those companies cannot come into the main listing page. So they often list in the emerging market. So there is called the SMEs platform. Then we have the fixed income securities. Fixed income securities, like it can be government securities, government issuing 90-day bill or a 365-day bill. We have the corporate bonds, bonds which are published by the companies. The bonds are there. Then we have the sovereign gold bonds. Okay, sovereign gold bonds has been a very good trend in the market, because sovereign gold bonds is basically the bond which are issued by RBI. The main benefit of sovereign gold bond is that you can take 2.5% of the interest in every year. So every year RBI gives you 2.5% apart from the appreciation of your gold. So what happens? Suppose you go and buy a physical gold. What you get is only the growth of the physical gold. Whereas when you come here, you can forget about, because this is getting credited to your demat account. So there is nothing called theft or anything. So you don't need to check even the purity of that particular gold, because this is 24 karat gold which is getting credited in your demat account. At any time, you have the option to sell in the market. So at that time, whatever the rate of the gold in the normal market, that rate will be available for you, and till that time you hold that particular bond, RBI pays you 2.5% of the face value. Then we have the bigger volume called derivative market. Okay, so derivative market are divided into equity derivatives. So some of the stocks which are already listed in the Indian stock exchanges are getting listed in the equity derivative segments also. Then we have the index derivative. Index derivative is Nifty, Bank Nifty are some of the examples of index derivative. Then we have the currency derivative, that is the USD INR pair, or the Euro INR pair, or the Yen INR pair, etc. Pound INR pair. So these are the some of the currency contract which are available in the currency derivative. Then we have a commodity derivative segment, because that's basically farmers or wholesale dealers who are engaged in many commodities like jeera, rubber, copper, aluminum, gold, silver, crude oil, etc. So these are some of the examples of the products listed in the commodity derivatives. Now we will come to the settlement cycle of exchanges. It is T+2 settlement cycle, which is being followed by exchanges. So T+2 is what, say today is Monday. Okay, today is Monday. I have to settle my suppose I am a buyer, I have to settle with my money within T+2. T+2 is, if Monday is the trading day, then T+1 is Tuesday and T+2 is Wednesday. So that is till by Wednesday, I have to settle my trades with the exchange. Similarly, if I am a seller, I have to give my shares to the exchange. So just see the terms which are normally used. It is pay in and pay out of shares and pay in and pay out of funds. So what we give as pay in to the exchange, okay, what we give as pay in is what we name as pay in to the exchange. So I give pay in as shares. So what does it mean? If I give pay in as shares, what does it mean? It means that I am a seller of the stocks. Suppose I am pay in the funds. So what does it mean? It means that I am a buyer, so I have to pay the funds to the exchange. So that's what that two terms belongs, pay in and pay out. So just it is represented in a picture format. An investor A buyer, his funds are getting flown to the broker order, and the order is gone to the exchange. Here an order is getting matched. So only when an order is getting matched, then an execution takes place. So an execution takes place, and on reverse order, you could see the trade confirmation, and later on, the share gets credited in your demat account. So what is debited from your bank account? It is the funds getting debited for investor A and shares getting credited in the demat account. Similarly, if it is a seller, this is an investor B seller, he is debiting his share from the depository, and whereas he gets the credit as funds in the bank account. Okay, so any orders that has, when we place an order to the exchanges, it has to go with minimum margins. So margin means, it doesn't mean that, see, suppose I have to buy Hindustan Petroleum at 500 rupees. Okay, it doesn't mean that I have to pay 500 rupees upfront. It's not necessary. You can buy the stocks with a certain amount of margin. So now, as of now, regulators say that every broker has to collect at least 20% of the margin to take these orders to the exchanges. So one such margin which you have to show to the broker or to the exchange is your cash. So in my example, which I have quoted, 500 rupees, say I have to place an order for Hindustan Petroleum for 500 rupees, then you should bring at least 20% of 500, that is 100 rupees as cash. Then only your orders will be accepted by the exchange. So that is one form of margin. Now, it's not necessary that you should always bring as cash. You can bring your margins as collateral also. So what is collateral? Collateral is nothing. You already hold some shares. Okay, you already hold, say, 1 lakh worth of shares. You need to take that stocks as collateral. So what you should do, you should instruct your broker to pledge those shares. So pledging doesn't mean that, okay, it will take away from your demat account. It is going to show in your demat account. You have the full option to sell your shares, but unless you pledge the shares, then you cannot take it as a collateral. So if you pledge the shares, then you can use the same margin instead of cash. So it's not necessary that you should bring in as cash. You can use your margins as collateral also. So collateral is nothing, idle shares which are there in your demat account, and you may pledge those shares with your depository and then raise the capital and invest it. So there are many people who are doing this kind of business also. I was talking about the 1992 when exchange came into existence. At that time, we didn't had a concept of internet trading or anything like that. But now, as of now, 75 to 80% of the volume happens in online. Online in the sense either through your home PCs or laptops, or the majority of the volume has been shifted to mobile. mobile phones. So we do also have an app in the Play Store. You can search as Selfie Geojit. So that's the name of the app. You can search in the name search Selfie Geojit and install the app in your mobile and start trading. So majority of the users now being not present because they may not be active traders. They might be doing some sort of investment here and there. So for such a person, it may not be feasible for him to sit at 9 o'clock and wait till 3:30. And even if you see the currency market is there till 5 o'clock, and if you see the commodity markets is there till 12 o'clock, 12 midnight. So that may not so a normal investor, it may not be feasible for him to sit at 9 o'clock until 12 p.m. understanding different markets and keep on investing. But there are investors who pick on certain segments or certain stocks and use the mobile platform in a good ways. So we will just now shift to the live trading platform. Okay. So you could see on the top right hand side. Okay, this was the index which we are talking about. So Nifty 50. Okay, today's quoting at 17,611. So every second you could see the ticks keep on coming and it keeps on changing. So the next to that, there is an indicator called, see, 100 points or 99 points. Similarly, Sensex, it is also shown as 59,000 and it is also showing an indicator. So what does this indicator mean? This means that what's the difference index has happened from previous day closing. So previous day means it was Friday, Saturday and Sunday are holidays for the exchanges. And from Friday to this time, 10:30, what was the difference for Nifty from the Friday's closing? So this means that it has gone up 100 points.
Still the PPT is
Sorry. I forgot to share the screen. Sorry. It is
okay, sir. Okay.
Is it visible now?
Yes, sir.
Okay. Okay. So I will repeat it. Okay. So this was the Nifty and the Sensex which we are talking about. The Nifty, it was 17,600 at present quoting, and on every second you can see the Nifty and Sensex keep on changing. So this point which I am referring to was the change. It has happened from previous day to this time, that is 10:30. We don't know what will happen when the market getting closed. Similarly, Sensex quoting at 59,000 and then it shows a rise of 292 points. So this means from index closing of the previous day, which is Friday, it has gone up by 93 points. So I was referring to you not only about Nifty 50. Okay, we can just see, okay, what does Nifty Bank says? Okay, so Nifty Bank is also up. So that index is also up by 384 points. Similarly, we can get any other index, say Nifty IT. Okay, so Nifty IT is also up. So IT means what? It will be the stocks which form the information technology. So Nifty is also up. So we will just bring back to the Nifty 50. So this is how we can list out the different indices in the exchange. I already referred to you that we have around 4,000 plus companies listed in the market. So it may not be feasible for an investor to look into every 4,000 or 5,000 companies which are there in the market. So we always tend to create a market watch. So what you see right now is a blank market watch. I've just created a market watch in the name of college one, and it is just a blank market watch. Now for this session, we will create our own companies in the market watch. If anyone can contribute, you can contribute. Otherwise, I will keep on adding some of the major stocks, ITC. Okay, so that's something related to FMCG. Then we can add one from the bank sector, SBI. So this is State Bank of India stock. We can add something from the IT, which is Wipro. We can add something from the steel sector, say. Ideally, we should add the biggest company, one of the biggest company, which is Reliance. Then we have been hearing because Adani Group actually have 4 or 5 companies listed in the market. So let us say, okay, let us list something called Adani Power. Okay, so this is another company. Let us list something for the Kerala market. We have the from Apollo. Okay. Let us add something for the from the hotel sector. Let us add something for the from the page. Let us add something for the pharma sector. Let's add something for the oil sector, Hindustan Petroleum. We will add Geojit. We will add that one from the agriculture sector, RCF. We will add some of the big listings which we had last year, IRCTC. IRCTC was one of the biggest listing. We will add okay, Paytm, one of the recent startups which has been listed. Anyone interested to contribute to the list? Start Unilever. And something for Narayana Hridayalaya, which is from the hospital sector. We have our own hospital. Aster Healthcare. Okay, anyone can contribute further? Okay, cement, ACC. Then the biggest sector, oh, I forgot that. That is Airtel. Sorry. So Bharati Airtel. So this Bharat Forge is from the defense. Bharat, here I just remove. Okay. Now, so this is the watch. Okay. So we are just concentrating only on these companies. So these are the companies which we would like to invest, and these are some of the best stocks which I have listed out here. It doesn't mean that these are the stocks which you should invest. It's not. There is nothing of sort that meaning. I've just listed some of the names which are much familiar for you. We have tried to bring most of the sectors inside this. We have the FMCG, banking, okay, NBFC, we have our own company. So NBFC, that is one of the companies which we have. Oh, banking, private banking, ICICI Bank. ICICI Bank. Now, if you see, this is the company name. Okay, this all represents as EQ. So that means these are pure equities. Then we have the exchange also. So I have just listed everything which is available in NSE. To have a basic understanding, we will have one from BSE also, the same stock which we will listed in, which we will the ITC also, we will see what are the rates in BSE. So the first one is NSE and the second one is BSE. You could see there is hardly no difference. Correct? The buyer, okay, this is the best buyer price. So that means here is the best buyer. So who will be the best buyer? Best buyer will be the person who will be quoting the highest price in the market. Okay, the highest price who are quoted in the exchange is called the best buyer, and who are quoted very less price is called the best seller. So that is why we call the best buyer price and the best seller price. So these are the best buyer and best seller. So when does the trade take place? When does a trade execution take place? It takes place when there is a matching of a best buyer price with a best seller price. So this guy is saying that, okay, I'm ready to buy at 236.90. So there will be seller who will approach him saying that, okay, I'm ready to buy at 236.90. And at that time, a trade execution take place, and then immediately your trades get executed. You could see these all stocks are highly liquid. That's why it keeps on blinking. Okay, every second or every millisecond, you have trade getting executed. I will just bring out, just concentrate on this particular column, LT price, which is the last traded price of any stock in the exchange. Okay, you could see the best buyer and best seller here, but see the last traded price. Okay, last traded price will keep on changing. See, last traded price is 236.95, 236.85. And here also it keeps on changing. So based on the buyer seller approaching the stock, then automatically the last traded price is changing. So what is this column? Percentage change. Percentage change is the change which has happened from previous day's close to the current rate. So that is represented in a percentage. And this is the net change. Net change is in terms of value, and percentage changes in terms of percentage. This is simple, day high and day low. So that this means what? You know that what is the price range this particular stock has moved. So from 235.30 low, it has moved to 238.75 high. So this is the day low and day high. This is open price. I don't want you to, okay, I will bring this column here. And I will bring this column here. Okay, so we were talking about the prices getting moving every millisecond. See the last traded time getting changed. 1049.35, 1049.39, and see the total traded quantity. This is the total traded quantity of ITC till 10:45 from today's market opening, which is from 9 a.m. So 54,89,000 shares has been traded in ITC, and this is the NSE ITC. And when it comes to BSE, that's why we told that NSE have the bulk of the volume in the exchanges. If you take any stock, it will be the NSE volumes, which will be high, but it doesn't have much significance because being a retail investor, you can place the orders at any of the exchanges. It doesn't have much difference. Okay, but the liquidity is quite high. You could see the last traded time getting changed in NSE quite often than the BSE last traded time. Okay, hope it's clear. Hope it's clear. There are the other points which you should note is that you get a closing price, what it has been closed yesterday. You get 52-week low and 52-week high. So what is 52-week high and low? It is year high and low. Okay, it is termed as 52-week high and low. It is termed as year high and low. So the on the year 1 year before, the low is 196.90 and the high of this particular stock is 265.30. So that is related to the code. So I already explained that this is the best buyer quantity, best buyer price, best seller price. So what you see in this particular row, you could see only the best buyer and only the best seller. We have something called market by price or market depth. We have something called market depth. So this is the window which shows the market depth. Now, whatever you see here is the first row of your market depth. See, here is the activity which is taking place. This is the buyer, 236.90. So I already told you that this is the best buyer in the market. Why? Because all the other buyers are below the best buyer price. So whoever quoted the higher amount is the best buyer. And these are the quantities which these people have tried to place orders. So we are just showing only the 5 best buyers. It doesn't mean that these are the only buyers in the market, because you could see 106, 1772, 2273, 3145, 111,456 on the quantities listed. But you see the total quantity which is there for buying, 14,81,000. This is the total quantity which is there available for buying in the market. Similarly, coming to the seller price. Okay, so seller, whoever quoted as lower is the best seller. You could see the other sellers all have quoted above the best seller. That's why they have come in the second, third, fourth, fifth position. So there are a lot of other positions, 6, 7, 8, 9, that exchange is not showing. Exchange is showing only the best 5 buyers and best 5 sellers. And you could see the total out here, the total sellers. It is 28,02,768. So these are the total sellers and these are the total buyers in the market. We have something called the daily price range, ceiling and floor. That means in ITC, you cannot place an order today above 259.70 or below 20. So your order placement ITC should be within the range of the ceiling and floor price. So this is everyday exchange fixes a ceiling and floor price at the exchange. Come on to the right hand side. Okay, this is again the same fields which we have explained here. Last traded quantity, last traded time, total traded quantity, total traded value, which sector it belongs, and what is the 52-week high, 52-week low, etc. And the face value. Face value is also important when you identify the price of a stock, because I will tell you another stock which is our own MRF. See, the price of the stock is 74,645. A stock cost so much. But if you see the face value, it is 10 rupee face value share. Whereas ITC, we saw it as a 1 rupee face value. So suppose MRF makes their stocks as a 1 rupee face value. So what will happen? 74,645 divided by 10. So the price will automatically come to 7,464. So that's how we should always look. That's why we always look into the face value of any stock. It doesn't mean that whenever if the stock is quoted high, that is the better stock. Nothing like that. We will see what's the face value of Asian Paints. Asian Paints is also the face value is 1 rupee. We will see IRCTC. The face value is 2 rupees. So if you convert the 2 rupee to 1 rupee, naturally 873 will come into divide by 2, which will come to 430 rupees. So that's what. So always look into the face value of the share. Okay. Now let us see how the purchase and the selling activities are happening at the exchange. So this is the order window. So this is the order window of the exchange. You could see the symbol as ITC. So the stock I have selected is ITC. And there is a place to define my quantity. What's the number of stocks I would like to purchase and the price at which I would like to purchase. And every user is represented by a unique code. Okay, so whenever you have a trading account, you will get the code because this code only exchange identify the user to whom this shares has to be delivered or has the shares has to be collected. Okay, so we can place an order in ITC. There are three conditions of placing the order. One is a limit order, one is a market order, and one is a stop loss order. For a better understanding, we will explain limit and market and stop loss. If time permits, we will just touch upon the stop loss also. So limit is what? Suppose I want to buy ITC. Okay, I'm not interested to buy ITC at this level. Because I'm not trying to bring me as a best buyer. I would like to purchase ITC only if it reaches 235. And the number of stock I am mentioning here is one stock, and I am selecting the exchange as NSE. Okay, so ITC, I would like to buy one stock and I have set as a limit price, and the price at which I would like to buy is 235, and then submit my order. So it's a confirmation. Once it is confirmed, now the order is at the exchange. So what will happen? Suppose the price moves to 235. That means if a seller comes at 235, then my order get executed, or else what will happen? Today, the order will get invalid. And the next day, you will have to again place the order for the next day. So we will see the order window. So this is the order which I have placed. I have some other orders also placed. Okay, so these are the orders which I have placed in the exchange today. So this is the ITC order which we have placed at 235 for one share. Whereas I have other shares also which I have placed before. Yes, bank I have placed one Gabriel, NHPC, Balaji Tele. So these are some of the orders which I have already placed in the system, and the ITC for the example purpose which we have placed is already lying here. I can modify this order if needed. So I will click on the modify order option. So again, the old order window is ready for you to modify. So I can modify the quantity if you want. I can modify the price. I can modify the price. Say I can just mention as 236, 236. Currently, the seller is at 236.60. So let us place something at 236.50. Okay. And again, I go on submit. So what will happen now? My order gets modified to 236.55. Now, if you see so right now I am best buyer. 236.50 is my order. So right now I am the best buyer. So, okay, see the order is not executed, I think. Now the order got executed. See on the right hand side, you can see the execution of 236.50 confirmed. Why? Because I was the best buyer. Now it is the price has further gone down to 236.40. So I have purchased at 236.50. Okay. In market, we can have two kind of trades. One is before that, I forgot to mention one thing. So this was the example which we are quoting, limit order. I can place that market also. So market means what? Whatever the price is quoting here at that time, at that moment, it will get executed. So I don't have a choice in the market. So market, you need not mention any kind of price. You just need to press the quantity and just send the order to the market. Okay, so see, immediately it got executed. So there is nothing called limit or market. So whatever be the rate at that point of time, it will get executed. There are basically two kind of trading. One is intraday trading and one is delivery based trading. So intraday trading means what? Normally intraday traders, they always look into the small movement of prices which is happening at the exchange. Say 236, 30, 40, I buy it, I sell it at 1 rupee if I'm gaining, or 50 paise I'm gaining, I sell it. Buying the same day and selling on the same day, or selling on the same day and buying on the same day, doesn't need to have any kind of pay in or payout of the shares. Why? Because every day is called a settlement. That is T day. I already told you that T day and T plus 2 is the settlement. T day being Monday from 9 o'clock to 3:30. Whatever your trades has been done. Say, take the example of ITC. I have bought ITC 50 shares. I have sold ITC 60 shares. I bought ITC 50 shares. I have sold ITC 60 shares. So what is 50 and 60 difference? Netting is minus 10. So minus 10 shares I have to give to the exchange. Now take another example. I bought 100 shares of ITC. I'm selling only 80 shares of ITC. So 100 is a buy and 80 is a sell. When you net off the 100 and 80, what you get the product as plus 20. So that means what? You are a buyer of plus 20 shares at the end of the day. So whatever you have done for 80, that's called an intraday transaction. And whereas what you have done for the plus 20, that is called a delivery transaction. Hope it's clear. Intraday and delivery. As an intraday player, there is one more choice for you. That is, every time you need not go for the stock to buy it. You can even go to the stock and sell it. You are expecting that ITC will come down and you expect that the price to go down. So you have the option to sell ITC and then buy at a lower rate. So that kind of trading can also be involved. So these are basically speculators or intraday traders, which they normally study the market and come to the market, and based on that, they go on investing in this kind of trades. I think in your session, you have already followed the concept of fundamental and technical analysis. Okay. So I will just touch upon those. Okay, so whenever you go on investing, we should understand the basic concept of the research that we need to do before going to the investment. See, this research, it doesn't mean that you will have to always go for the research and do. There are many research outcomes or research products which are already available in the market. Whatever the fundamental research analysts say, you can go on understanding that analyst report and go on investing. That is one kind of fundamental. Technical research also, you have many technical analysts who are doing the technical research, and you can go behind them and see what they are investing. So fundamental research, I think you already had a separate session on the fundamental research. It is basically the study and analysis for stock market movements using historical data, news reports, etc. So whenever the company publishes the P&L statement or the balance sheet or those things, you take those, the fundamental research analysts take those data from them and analyze it. Financial reports are analyzed with the help of ratios. So each of the ratios are compared. Useful for long-term traders. So that means what? I am a long-term trader. That is, I am an investor in the market. I am not come into like for the intraday trading purpose. I'm not going to buy and sell on the same day or sell or buy on the same day. I am going to invest for a long-term purpose. So for such clients, is always the fundamental research which is beneficial. Uses expectations which versus actual outcomes for analysis. So what is your expectation? Okay. Say I am saying that okay, Indian Oil Corporation, since the prices of the crude oil is going to have a crude oil is going to have a bigger fluctuation due to the new pandemic issues. We see that okay, IOC may not be functioning better, and we analyze the balance sheet based on that. I'm of the option that okay, we should not buy IOC beyond of 150 rupees. Okay, that's my expectation. But when the outcome comes immediately after the quarter result, we see a good quarter result, and I see that the price is getting dropped down to 150 rupees. So this is something which we are expecting based on the balance sheet or based on the historical reports. We are expecting that IOC is going to perform in the coming quarter, and based on this, I am going to buy that stocks for a period of say 6 months or 1 year or 10 years, etc. Now coming to technical research. Technical research are actually the study of analysis of price patterns and share volumes. I will just show you a charting solution also. Charts to understand share market trends are used. So to understand the trends, charts are being used. Useful for short-term trader or the ones who switch between short-term and long-term. So what happens? See, I'm a long-term trader. I bought Infosys for a very long period, but Infosys is going to I will analyze my Infosys. Okay, what is going to come in the next week for Infosys? So I say that technicals say that Infosys is going showing a bearish trend, but still I am an investor. What I will do, I will just set off. I will just square off my Infosys with a strict stop loss, and I will buy that Infosys towards a in a lower level. Okay, so that's a short-term trader who adopts such techniques. Uses trend like support, resistance. So we always have heard about such terms like the support of a stock is this much. When support gets break, this can be touched. The resistance of the stock or an index is this much. When it breaks, it can touch to those levels. So so this is the basic difference between fundamental research and technical research. Fundamental research is always used by long-term investors, whereas technical research is always used by very short-term investors. So the technical tools which are being used are MACD indicators, moving average. So moving average is nothing. You take the average of that particular stock trading for the last 1 year or 3 months or 1 week, etc. And based on that, the moving average is formed. There is some study called Bollinger Bands, relative strength index, Fibonacci retracement, Ichimoku cloud, standard deviation, average direction index. So these are some of the technical terms which are used for the charting, inside the charting for the technical study. It doesn't mean that these are the only studies. Even in our charting solution, we have around 70-75 such technical studies available. So like we used to expert us in 1 or 2 technical studies, and based on that, we go for investment. Fundamental research, I am not going to stick on to the fundamental research tools. Earnings per share, price to earning ratio, return on equity, price to book ratio, price to sales ratio, dividend payout ratio, dividend yield ratio. These are some of the examples of fundamental research tools. Okay, now let us come back to the trading. Because why I shown, because the fundamental research and technical, because you already have a fundamental research available in the platforms. Okay, so whenever you go for investment, you will get such kind of fundamental studies already available. You need not go to the balance sheet of the company and understand the report. These things are already available in major. In our platform, it is available. So what does it say? It says that you can have a buy on what ITC with the current market price at 227 and target as 260. So the expected return is around 15%. So based on the closing of 1st November 21, this research has been published, and the reason for this research is given as a explanation in the whole fundamental research report. So as an investor, you can go on and see on what basis it has been recommended. So this is an example of a fundamental research report. So you can see mainly such fundamental reports available against different companies. Now let us see what the technical studies has to say. Okay, so this is the real-time chart, because I already told you that technical studies always go on for the charting, and we see that there is a see the movement of movements tend to follow the historical pattern, and you see the on December 8 what has happened at 12:54 time, what the price at which it has been traded. So this is basically a candlestick model. I will just enlarge it. You can see why it is, sorry, this is a line model. I will just turn to a candle model, because candle is the so it looks like a candle. That's why it is called the candle chart. Okay, so it looks like a candle. And the formation of the candle, because see, each of these lines which represents the candle, it has its a meaning. Okay, there are many technical terms used as crosshair or the hammers which are getting formed. So you could see the candle is bigger here. Okay, whereas the lower tip is very small, whereas here the lower tip is very high, and here also it is in green. So whenever that particular minute, because there is a tick by tick chart, every tick is a chart is getting formed. So whenever there is a difference in the chart forming pattern, then automatically the analysts identify that there is an opportunity for buy sell. So when you have the very good data on the charting, you may not even understand that this is a candlestick pattern. So this is an example of how the technical studies are being captured using the charting solution. So this kind of charting solution is always available in the trading terminals. Okay, so I think you have noticed this. Our price was at ITC we have bought at 236.40, and the other one was 236.50, and now it is trading as 236.20, which is a 30 paise difference. Anyway, we have time till 3:30, and if I needed, I can place the order even now. So let us place an order now. I say that okay, sell in NSC, ITC, say one stock. I say that okay, sell if it reaches to 37.50 and submit. Okay, so now the order is confirmed in the exchange, and suppose it reaches to 37.50, then it will get executed. Otherwise, I will have to take delivery of this particular stock. Continuing with the presentation, whenever a trade takes place in the exchanges, you will have to pay so and so figures to the broker or to the exchanges. So one is the brokerage, because brokerage is the income which a broker avails for, broker gets for availing this kind of services. So Geojit being a broker, we normally charge 0.30% for the delivery transaction. 0.30% means what? For every 100 rupees, 30 paise brokerage is charged. So every 200 rupees, 60 paise charge, or for every 300 rupees, 90 paise is charged. That's for the delivery trades. Whereas when it comes to the intraday trading, it is much less. It is 3 paise which is getting charged. So that means for 100 rupees, 3 paise is charged. For 200 rupees, 6 paise is charged. For 300 rupees, 9 paise is charged, etc., etc. So that is how the brokerage works out. Then we have the GST. That means whatever the brokerage charge, 18% of GST will have to be given. So if you are 3 paise into 18%, you will have to give as the GST. Then we have the exchange levy. We have the SEBI turnover fees, then we have the security turnover tax, then we have the AMC of depository. Say depository, when you open an account, open a demat account, there is an AMC, annual maintenance charges, which is getting paid. Similarly, there can be charges for delivery instruction slip. So delivery instruction slip is like a check leaf. Okay, you get a check leaf when you open a bank account. Similar to the check leaf, there is something called delivery instruction slip. So delivery instruction slip, you will have to write down. Suppose you would like to give the shares to another person, then you will have to write in the delivery instruction slip like a check leaf saying that, okay, from my account of so and so, please credit the this particular account of so and give to the depository participant. They will act on your delivery instruction slip and debit your demat account and credit the other party account. So for that, you need to have the delivery instruction slip. When I mentioned about the stocks, I just forgot about. Okay, I will delete some of the stocks so that we get the. Okay, I was referring to the some of the ETFs, exchange traded funds, which I was mentioning about. We have an asset called gold bees. Okay, so this is actually gold bees is an ETF which is represented by 1/100th value of a 1 gram of gold. So if you multiply into 100, you get 1 gram of gold. So you can, if you are an investor who would like to invest in gold, you can start investing in this particular ETFs. So this is one such ETF. Similarly, I already told you that there is something, if you would like to invest in Nifty. See, Nifty is 189.76 in the exchange, whereas the Nifty is quoting it. So whenever the Nifty goes up, see 17,561 is the Nifty. Whenever the Nifty goes up, then automatically the Nifty Bs will also move up. So the basic asset in which this ETF is getting traded is based on the Nifty 50. So if you would like to invest in the Nifty 50, because Nifty 50 otherwise it consists, we already told that it's a group of 22 to 23 sectors which consists of 50 stocks. So it may not be easy for you to have the investment in complete weightage, because I already told that that particular index is having Reliance at a weightage of 10% or more. So if you go on investing in Reliance, see 2427 is the Reliance. So 10% out of, so at least you will have to involve 1 lakh or 2 lakh worth of corpus to invest in Nifty if you are selecting otherwise. But Nifty Bees is very handy because with around 200 rupees, you can start investment in the whole economy of India. So that is related to Nifty Bees. Then we were talking about the sovereign gold bond. Okay, so this is the sovereign gold bond, one of the sovereign gold bond. Okay, because every quarter, every half yearly, RBI publishes a sovereign gold bond. So this is one of the sovereign gold bond which is going to expire in the year 29, and this is the 8 series of gold bond. So you can see that there is buyer at 4686 and seller at 4710. So this carries a 2.5% interest on the face value of sovereign gold bond. So if you would like to invest in gold, this is another option. Now the basic difference here and here is that here you can start with very low amount, whereas here at least you will have to pay for 1 gram, and this is 24 karat, and that too here the benefit is that you get 2.5% on the face value, whereas here you may not get any kind of interest. So these are example of ETF, and this is one of the example of sovereign gold bond. Now we will see couple of debentures. Okay, so this is one of the example of debenture. So this carries fixed income. Okay, you have seen Muthoot or Manappuram in Kerala. They used to generate money for the loan business. They used to invite deposits. Earlier it was fixed deposits, but now NBFCs are not permitted to raise funds through fixed deposits. So they raise it through the debentures. So these debentures are also listed in the exchanges, and at any time, if you have any seller available, you have the option to sell and buy. See the Hutco. This is an example of Hutco. It's a NCD. So here there are 20 buyers which are available at 1232, and here there are 500 sellers which are available at 1240. The bonds are not as liquid as equity. If you see the liquidity, see here actually there is no trade which has been done today. Whereas when you come to the equities, you could see the bulk of trading happening in the equity segment. So the bonds, some of the bonds, there are some of the active bonds, but some of the bonds are not much as traded in the exchange. So I may not say that it's rich liquid or anything like that, but if you have the bonds or NCDs available, you can come over here and execute in the market. Okay. Now I will just touch upon the derivative markets also. We will just see ITC itself. Okay, so what is ITC trading? Okay, so this is the ITC future. So that's why it has now changed into NSE F&O with an expiry date also. See, I can just mention some of the points of derivatives only, because derivatives is a very vast subject which consists of futures, options, and I already told that there are different other products like currency derivatives and commodity derivatives. So just to have, I'm just introducing that particular market. That's all. So if you see ITC, okay, I will just quote the ITC also, bring out here. Take Hutco away. Now you have both the ITC here. So the ITC of NSE is 235.90, whereas in the futures market, ITC is quoted at 236.40. So that means what? There is an expiry date here on 30 December 21. So this ITC expires on 30 December, and thereafter this contract will not be available. So this is not share. Okay, this is not share. This is a contract which is always traded based on the asset price ITC. So whatever the price quoted in ITC will have a will decide on the pricing of ITC in future market also. You could see a slight difference between the ITC of equity and ITC of future market. This is going to get equal once it is nearing to the expiry. It's like the agriculture market that we have in Kerala. I think in many of the newspapers, if you have read in Malayalam newspapers also, you could see something called Avadi Vyaparam. Okay, so that's the future market. Similarly, if you take the English newspapers also, you can see the future market of different commodities which are available. So here we are not talking about the commodity, we are talking about the stocks. And I have just quoted one of the examples of ITC as a contract against a stock. And every time the future also, you can, as an investor, you can go on buy and in future. The benefit is that actually in future market, you are not buying the stock. So you are not a shareholder. You are just buying a contract. But if there is an appreciation, or if there is a if the prices tend to go down of ITC, you can benefit by investing in ITC. The thing is that you need to pay just only the margin, say only 10% or around 10% I need to pay for the contract, whereas here I have to pay the full amount. So that means if I am buying 1000 ITC, I have to pay 2,36,000. Whereas when it comes to ITC out here, I see here it trades in a lot size. Okay, if I take the market by price, you could see that it is the multiples of 3,200 getting traded. So 3,200 is the minimum lot size in the future market for ITC. Whereas in the equity market, you can even buy with a one quantity. Whereas when it comes to future market, you have to at least buy a 3,200 lot. But 3,200 into 236, that you need not pay in here. You need to pay only a margin of that particular amount. So what is the benefit? You are investing only a certain amount in the market. You are investing only a certain amount in the market. You are not, but at the same time, you are reaping the benefits of ITC, which is getting appreciated. Suppose I buy the future at 237.20 and suppose the ITC moves up to 240. I am benefited more in the future market. Why? Why? Because I am not, suppose 3,200 into 3,200 into 236. I have to pay 7,55,000 here. Whereas when it comes to the future market, I just need to pay around 1 lakh only. Okay, so with minimum margin of 1 lakh, I can make the money of the same movement. Whereas I have suppose I am a buyer of futures and you are a buyer of cash market. You pay 7,55,000. I pay only 1 lakh or 1.5 lakh. But the benefit that we both get is the same. Correct? If 1 rupee goes up, what will happen? I get 3,200 rupees. So what I got from 3,200 rupees as profit is just by paying 1.5 lakh. Whereas what you get from 3,200 profit is by paying 7,55,000. So which return is more? My return is more because I have invested very less. So that's basically the concept of future market. The future and options. So the derivative market is just a place wherein it should be treated as a hedging instrument. Okay, it should be just treated as a hedging instrument. So derivative was introduced in the market as a marketplace to play for the as part of a hedging tool. Okay, you could see the price movement of ITC. We all started with 236.50 and all. See, 50-60 paise has gone up in the last 5-10 minutes, and our purchase rate was at 236.50 and 36.40. So right now I am in a profit of 50-60 paise. So here in intraday, because I just pay only the margins, I can buy more. Okay, say 1,000, 2,000. So if 2,000 shares has been bought, 2,000 into 50 paise, it is 1,000 rupees, which has been profit. So just represent this particular one quantity in thousands or 2,000. That makes the value for all of us. So I have just the session questions are open to you. If you have any queries, let me know. Okay, I don't know how many of you have seen that. That is executed. The price at which I have placed the order, it got executed. I will sell the balance also. I'm selling at market. Executed at 237.80. Okay, so the 3 stocks which I have purchased, I have a profit of 2 rupees 60 and 1 rupees 10, total to 3 rupees 70 paise. So that's a profit which we have made from the today's session. Any queries through chat or something like that? Let me know.
Just a second, sir. Participants are requested to ask any queries if you have.
Good morning, sir.
Yes, good morning.
May I?
Yes, please.
Yeah, sir. I'm sorry. Am I audible?
Yes, it's audible. You can continue.
Okay. So my question is, sir, I listened to the your talk, but in between I got cut off.
Okay.
So I'm not sure whether you mentioned this somewhere in between. But as my question is from a layman's point of view, sir. So when you're investing in the share market, uh, let's take the point of view from one share. So if I have bought one share of any particular company and I want to sell it, is there a minimum amount that the share price should rise before I sell so that I make a profit? Because just because the price has increased, it doesn't necessarily mean that I'm making a profit, given that there are taxes and so many other indirect cost involved in it. For example, the shares you bought today of ITC, you said you made a profit of 3 rupees something. Is that really a profit? Do you get my question, sir?
Understood. I understood. So the thing is that your query is related to the market movement. Okay, so just see my investment as an example. Okay, the brokerage or the other taxes which will be accumulating to this particular transaction. So let me quote an example. Okay, let us say this ITC itself. Okay, so 3.03% is the brokerage which you pay to the broker. So what will happen? It is a 230 rupees share. So you may pay 6 paise or 7 paise for the trade. You understood how? That is 230 into 0.03%. That is on the buy side. 230 into 0.3% on the sell side. So
okay.
Let us say 7 paise. That's the brokerage that you pay for this. For the 7 paise into 18%, you pay GST. So let us add one more paise to that. So it becomes 8 paise. Now, for the STT, it may not have an STT because it's a very low trade. STT for intraday trades are very less, whereas when it comes to the delivery trades, it might be 0.12 paise. So that we will have to keep on adding. So let us add STT also to 1 paise, which is 9 paise. Apart from that, you may incur one more paise related to the SEBI exchange levy, etc. So the altogether for this transaction, you may incur a charge of 10 paise. So when I told you that from 236.40 was the cost, 236.40 plus 10 paise. So 236.50 might be the cost for me. So 236.50 minus my selling rate. That would be my profit. So ideally what I'm trying to convey here is that for an intraday trade, okay, if you are intraday trade, I already told you that buying on today and buying today, selling today, or selling today and buying, squaring off the trades for the full day. That is what we call intraday. So intraday, of course, the brokerage will be less and all the other charges also will be less. So we can say that, okay, 10 paise might be the cost that you will incur for a 200 rupees share. Okay, so for a 300 rupees share, it might be 15 rupees. For a 400 rupees, it may, sorry, 15 paise. For a 400 rupees share, it might be 20 paise, which you will incur. So similarly, it can go on. Suppose it was a delivery trade, suppose ITC was a delivery trade, we always expect the price to move a bit higher because for intraday, we expect the price to move 1 rupee or 2 rupee. But whereas when it comes to the long-term investment, we are targeting a 15% or a 20% or a 25% growth. In that case, the ITC shares tend to move higher, might be 270 or 280. So that means my profit will be my profit span will be for 50 rupees. For that, which we were talking about was 10 paise. There it might be, you might be incurring an expense of say 1 rupee 20 paise or something like that, or 1 rupee, because 0.30% is the brokerage that you have to pay, then GST you will have to pay, exchange levy, STT, etc. So there might be a 1 rupee additional expense that you will incur. If you are talking about a delivery trade, then your expense ratio will be much higher because you are a long-term investor. You tend to make more money for the because the price movement of the stocks will be more in the next 3 months or 4 months or 6 months or 1 year. Whereas for an intraday trade, it might be very less. So that's why all the charges for an intraday traders are kept lower. Hope I answered the question.
Yes, sir. Yes, sir. Thank you, sir.
Thank you.
Is there is any other queries?
Those who would like to chat also is welcome.
I hope we don't have any other queries. Anu,
Yeah.
shall we wind up?
Yeah.
Yes. Yes.
So it is an honor to have been asked to offer to a word of thanks on the occasion of FTP meeting in our college. On behalf of my college and entire faculty members here, I am very heartily gratitude to Mr. Vipin for sharing his grateful and inspiring words with us today's session. Thank you, sir. Thanks a lot. Have a great day. And all the members who have gathered here, we are also thanking for all the members, all the participants on our FTP programs. Once again, thank you for all, and a wonderful day for you. Thank you.
Thank you, right, bye.
Vipin sir, thank you so much, sir.
Thanks.
We'll get back to you.
Participants, you have a feedback form which is available in your chat box. Please fill that. Please fill that as soon as possible.